What's up everybody, Investing Club here, back with another video. In this video, I want to go over a small cap stock that I have recently bought into and made part of my portfolio. In my opinion, this stock is massively undervalued at the current levels it's trading at and has the opportunity to go up by 4 or 5 times in the next couple of years. And before we start this video, I just want to say I am not a financial advisor. This video is not financial advice. It is purely for entertainment and educational purposes only. Do not buy this stock just because you watch this video. You need to do your own research before you buy any stock, and you should consult with your financial advisor. I am not recommending the stock to buy for you. This is just a stock where I see a potential to make money, so I put my own money in it, and it might be a different situation for you. Now, before we get started with the video, be sure to hit the thumbs up button and subscribe to the channel if you haven't already. I greatly appreciate all the support, and now let's get to the stock. The stock I am talking about today is Cumulus Media, ticker symbol CMLS. And Cumulus Media is the third largest operator of radio stations in the United States. Okay. Before you click off of this video, I know what you're thinking. Come on, radio stocks? Are you kidding me? No one even listens to the radio anymore. Why would you invest in this? And I'm sure a lot of people are going to think this, but I think this is a very important point to make. I like to invest in stocks that are good value, that are at a price that is deeply discounted from their true value. And what that means a lot of the times is going to industries where other people don't want to go, where it's unattractive, where it's boring, where you don't think there's a future in the industry. That's where a lot of the time you're going to find these massively undervalued stocks. And so I don't think it's a problem going to these unpopular industries, because I see a better opportunity to make money investing here than investing in what's super popular. Like if you invest in Apple at over $300, when it's all everyone's talking about, the odds are the return's not going to be that great over the next 5 to 10 years. So let's dig a little more into this company. This is their investor presentation straight off their investors relation page. And I highly recommend taking a look at this because it has a lot of useful information about the company. Now, a few things to note. First, this company, in addition to their radio station, they have a large podcast segment, which I am pretty excited about. I think this is the biggest opportunity they have for growth in the future. As we see here, 1 in 3 Americans have listened to a podcast in the last month, and by 2023, that time is expected to grow by 6 minutes a day. So the podcast industry is a growing industry. There's been 47% growth in podcast listeners over the last couple of years. So I think the podcast industry is a very good spot for this company to be in. In addition, a lot of people think radio is dead, and there's data to suggest that radio is still going strong. Out of television, social media, apps, and radio, the largest percentage of people aged 25 to 54 is with AM and FM radio. So despite the notion that radio is dying out, it is actually very resilient and has held up well in a time where people thought radio would slowly fade out, like so many other industries. So this company has an audience of over 250 million people a month. They have 428 stations in 87 different markets, and they have the #1 national audio network. And they syndicate a lot of the content you've probably heard of. Associations like the NFL, CNBC, NCAA, CNN, the Olympics, and a wide variety of podcasts all are covered. Now, some highlights from 2019. They grew revenue. They had same station revenue growth for the second consecutive year, right? And digital growth of 60%. So like I said, the digital industry is where the majority of their growth will most likely come from in the future. And in the last 2 years, they've had a new CEO. And I'm going to talk about that a little bit later in this video, but I think that CEO is driving the change in this company. In addition, EBITDA growth for the third consecutive year, excluding political. So a lot of people don't know this about the radio industry. In election years, radio broadcasting companies make a larger amount of revenue just because of the amount of political advertisements that they will get paid to play. And I think that's an important that not a lot of people know about, even though this company's revenue and earnings will take a hit this year, as will the vast majority of companies right now. It might not be that bad because this is an election year for the presidential election in the United States. And so there's still going to be a lot of political ads that Cumulus will get paid to broadcast on the radio stations. In addition, they had $220 million of debt pay down reducing their net leverage, this company has placed a high priority on paying down their debt. They do have a lot of debt, which I will go over, and it is probably the biggest risk of this company, but I think they are in a position to handle this debt. Like I said, 275 million of debt pay down since emergence from Chapter 11. So like I said, their digital business is going to be the majority of their growth, with streaming, marketing services, and their podcast network, which had 60% growth last year. In addition, they've been selling off some of their assets to help pay down their debt, which I will go over. And these are their financial goals, which I think are pretty good. First one, generate 100 million of free cash flow per year. That's a great goal. 2, reduce their net leverage as quickly as possible. So I think it's great they are placing a high priority on paying down their debt right now. As you can see, this company has been voluntarily prepaying the payments on their debt ever since 2018. So this company has definitely made it a huge priority to pay down their debt, and their net leverage has been reducing, as you can see from this graphic. Their current capital structure, even though they do have a lot of debt, when they restructured it, they extended the maturity. So now their debt is not due until 2026. And until then, all they have to pay is the interest payments, which I believe they will be able to do. And they will definitely be able to raise enough cash to make the full payments in 2026 or roll over that debt in the future. So what's the story behind this stock? This stock has been around for a while. And what happened was, this company was a strong company, and they had a CEO in the early 2010s that started taking on a bunch of debt and really ran this company into the ground. And it got so bad that in 2016 to 2017, they defaulted on their debt payments and filed for Chapter 11. And since then, they have had a new CEO and have successfully restructured their debt in a way that I think makes the company much more sustainable into the future. And to show this point, I want to look at the growth rates of this company since the restructuring happened. It was around 3 years ago. So I want you to take a look at the difference between this time frame and this time frame. This time frame was the old CEO, where the company was not operating to its potential. We see the book value was only growing at 5% a year. The operating cash flow was falling, and the sales were falling. Ever since the new CEO took over, this company has been going in a much better direction. Book value has already grown by 200%. The earnings per share have grown dramatically. Sales growth have grown. And in addition, the returns on equity and on invested capital are outstanding over the past 3 years. So I think the main story with this company is there was a poor CEO in the past. They took on way too much debt and they went under. And upon restructuring of their debt and a new CEO that I think has the right mindset to lead this company into the future, I think this company is well positioned into the future. So guys, what happened to this stock? This stock emerged from Chapter 11 in 2018, and they've been trading in this range of around $20 to $15 ever since that time, except for the last month or so, where the stock has dropped from all the way at $18 at the beginning of this year, and they're now trading at $3.50, which is just a steal in my opinion. Looking at the future growth of this company, it's projected to be very good. Just to give you an idea of how undervalued this company is, we can take a look at their cash flow statement. This is on MarketWatch's website. And we can come down to their free cash flow right here. For 2019, their free cash flow was $70 million. So if you keep that in mind and we come back to this website, we see that their current market cap is what? Their current market cap is $60 million. So this company is currently being valued at $60 million. And this is a company that made $70 million in free cash flow last year, which is just, it doesn't make any sense when you think about it. There's no logical reason why this company should be at $3.50. Their price to free cash flow ratio under 1, which is pretty much unheard of. This company is priced like it is about to go out of business, which I don't think it will. Of course, there is a priority. They do have a good amount of debt. However, their short-term financial situation is strong, with a current ratio of 2.7. And, this company is expected to grow at 10% a year. This company is still growing, and on all of these metrics, the PEG ratio, price to sales, price to book, it is undervalued on all of these metrics. And again, I think the fair value of this company is somewhere around the the $16 to $20 range. Around $18 is the median of that. And so that's where I fully expect this stock to get back up to whenever this global shutdown comes to an end. Assuming that they can survive this period, which I think they will, this is a very strong company that is severely, severely undervalued right now. Their stock just fell from $18 all the way to $3.50. The main risk of this company is their debt, as I said, and here we are in Guru Focus, and we can see their interest coverage is 1.73. So their earnings cover their interest by not even 2 times, which again is not good. However, if they can maintain, if their earnings don't drop by half, which I don't think they will drop by half, they will probably drop maybe around 20 to 30%, I would say, depending on how long this goes on. It could be more. But I think the combination of, radio stations are still receiving revenue, the fact that it is an election year, and radio stations historically always bring in higher earnings during election years. But their debt definitely is a risk, and I generally don't like to invest in companies with a lot of debt, but I think the risk reward here is too much to pass up. And so I made this a very small position of my portfolio. Right now, it is not a very large percentage, and because I think if this stock returns to what its true value is, then it will grow to be a large part of my portfolio. Okay, and so lastly, I want to take you through this article on Seeking Alpha where someone wrote a very detailed analysis on this stock. So like I said, their debt doesn't mature until 2026. This gives them a very large period of time to get their finances in order, and until then, all they have to keep up with is the interest payments, which I think they will be able to do. Right, and they, as I said, they've been selling off their assets to raise cash. They sold off a station for $12 million, and they are in the process of selling land to Toll Brothers for $75 million, which they're in court for that right now. And there was recently some good news in terms of the court's judgment for that. It looks like it will be able to go through, and they will be able to sell the land for $75 million, which definitely gives them a large amount of breathing room for these interest payments. But I think the largest asset they have that is being taken into account when the stock is being valued they have a portfolio of 250 tower sites. And these tower sites are going to get more and more valuable as industries like the 5G industry develop, because these are the towers that are used for 5G towers. Similar deals with other companies selling these tower sites the towers have been valued around $1 million per tower. So this is potentially $250 million in assets, in hidden assets that this company is sitting on that no one really knows about. When you try to find undervalued stocks, this is definitely a way to do it. Looking for assets that people don't think are there, that you see they're hidden assets that aren't clear on the balance sheet, but if you dig into it a little more, you'll be able to see that this company has a lot of value in their assets that can be unlocked by them selling the towers. So given any situation where this company's under stress, they could be able to sell those towers. Maybe if they have to sell them more quickly, it'd be under the $1 million mark, but they would still get a substantial amount of cash from these towers. So ultimately, where do I see this company going? We can come to the Rule 1 Intrinsic Value Calculator, which is one of my favorite tools for valuing stocks. As we said, their future growth rate was around 10%. We can put their PE ratio at 8, which is a very conservative number and is around their long-term average. This website calculates the intrinsic value at around $15, and again, they are currently selling at $3.50. So the value to be had with this company is outstanding, and this is why I invested in this company. I think the risk reward is one of the best I've found in the market right now. Even though I've said in the past I am not bullish on the stock market right now, and I think the stock market will continue to drop in the next weeks and months, if you look at this company, the price hasn't gone up. The price is pretty much at its lowest point in the past year, where I see so many other companies that I want to invest in, but their prices have jumped up 30%, 50%. Some companies stock prices have doubled since their lows in March. And so I just can't bring myself to invest in those companies because they've just gone up so much, and I don't think it's sustainable. I think a lot of them are going to drop back down at some point. But I think this is a great entry point for this stock, because it is at the lowest. It's at its lowest point pretty much since they emerged from restructuring their debt. So what do I think is going to drive the stock back towards fair value? Well, again, I think it's just the pandemic we're having and how everything's shut down. And this company I think is being placed in the category with all the other companies and I just think that's not the case for this company. As I said, they have a lot of assets that you wouldn't know about unless you do a deep dive into this company. And so I think once this situation clears up, once they start generating cash flow again, I think this is a small cap company too, right? Their average volume is around 100,000 a day, a very small cap, as I said, 60 million market cap at the moment. So I think all it's going to take is one large institutional buyer, and there have been institutions in the stock in the past. So I think it'll just take one institutional buyer to say, hey, this is a really good deal, and start buying. And that will shoot the price up of this stock. And I think, again, the fair value is around the $14 to $18 range. And again, this is not a recommendation for you. I'm just going over why I am investing in this stock. If you are seriously thinking about this stock, I highly, highly recommend reading through all of their annual reports, all of their quarterly statements, read up on the CEO, because she has been very effective in turning this company around. And definitely do your own research before investing in a company like this. Again, it is a small cap. There is a lot of debt, and that is risky. But in my opinion, this company will make it through the next few months okay. And again, after that, I think the price will go shooting up. So that's all I want to cover in this video. I'm trying to bring you guys stocks that no one else on YouTube is covering. There's not a single video on YouTube, or really, I don't think I've seen a single article anywhere on the internet really covering the stock besides the one I showed you in this video. So if you like that, I'm bringing you these undiscovered stocks that are really what will make you money investing. Subscribe to the channel, and I always keep on the lookout for stocks like this, and I will update you as more of these stocks become available. So that's all, and I will see you on the next video.